The MACD is one of the most popular indicators that traders use, which is used to identify potential trend reversals and momentum shifts in financial markets. However, similar to other popular tools, this indicator has a major problem. It gives a lot of fake signals. However, there is a free and unknown TradingView indicator which was created based on the MACD line and its signal line that gives more accurate and effective signals. As you can see, its signals are more consistent and allow you to catch larger price movements. And so, in this video, I will introduce you to this new indicator, show how to use it and also test it on more than 6,000 trades among the Forex, crypto, gold and stock market to discover its real efficiency. So, this new indicator, which is more accurate than the popular MACD, is called Derivative Oscillator. On the TradingView, you can find some versions of it, but the one that I will use is this one provided by Everget. In addition, you can also get the code of my version by going to the free materials channel for my free Discord community. As I told you, the Derivative Oscillator is a better and modified version of the usual MACD indicator. This oscillator generates signals based on the convergence and divergence of the MACD and signal lines, indicating whether the market momentum is increasing or decreasing. Similar to the MACD, it is formed by these histogram bars which reflect the momentum on the market. When the histograms are green, it means that the overall market's momentum is bullish, and when they are red, it means the momentum is bearish. Then this indicator is also formed by this line, which is the signal line, but that will not have any use for us in this video, and so I will uncheck it to clear my histogram. And how do you know where to find the signals? It is very simple. When the histogram bar flips from under to above the zero line, so when the first green bar appears, it means it can be a good opportunity to enter a long position, and when the opposite is true, it means the momentum may drop, and so it can be a good time to enter a short position. Also, as you can see, on the default settings, this indicator gives some fake signals, and for that reason I tried some different combinations of settings and found out that by using 14 for the RSI length, 12 for the first EMA, 9 for the second and 22 for the SMA, the signals are more consistent and with greater probability of success. But to confirm the results of this indicator, we will need to backtest it. As I usually tell you, to conduct a proper backtest, you need to have first the technical system, second the risk management rules, and third the testing conditions. Regarding this last step, if you have been watching this series, you already know that my testing conditions are always the same, so I can compare the different indicators I test fairly and efficiently. So I will backtest the derivative oscillator in 3 different time frames: the 30 minute, the 1 hour and the daily one. On every time frame, I will use the data sample from 2022 and 2023 with all the available trading sessions with an efficient and diverse portfolio of assets from different markets, which are Bitcoin, Ethereum, XRP, 3 currency pairs, gold, oil, the S&P 500 index and the Apple stock. Then I will present you the results of every asset individually and also together, because for every backtest I will create a trading journal with all the trades given by the indicator in the 3 different time frames. Regarding the second step, the risk management, it will also be the same one I used in the other episodes, using a 2% risk per trade, a stop loss calculated based on 2 times the average to range indicator number, and by using a take profit on the 1-to-1 risk to reward ratio zone. If you would like to know more about this risk management system, check out the first episode of this series. Finally, regarding the technical system, in addition to the derivative oscillator, I will also use a 200 period exponential moving average as a baseline, just to filter losing signals from the indicator, in a way that I will only consider entry signals that are in the same direction as the trend given by this baseline. Here you have an example of a long position where the price is above the 200 exponential moving average, and here you have a short trade example where the price is below this baseline. And in the 2 examples you can see that the stop loss is 2 times the ATR pip value at the close of the signal candle, and the take profit is on the 1-to-1 risk to reward ratio zone. And so these are our backtest conditions. Now, the most popular way of backtesting is pretty simple to do. We just need to go back in time and check every signal manually, taking notes of the outcome on a paper or Excel sheet. But as you can imagine, this is a highly exhausting process that will take us some weeks or months to perform in some assets. But if you have been watching the episodes of this testing indicator series, you already know that I like to use a special tool to backtest indicators in a quick, simple and efficient way. And for that, I will add that indicators testing bot to my charts. For those who don't know, this is an innovative tool that allows quick testing of indicators, and that from week to week has new indicators added to its database. In the last episode, we had 34 indicators available to test, and now we have 4 new ones. With this tool, I just need to select the indicator I would like to test, and in 1 second, I have all the results on my chart. After selecting the data sample, the risk management, the derivative oscillator with the settings I told you about, and the 200 period exponential moving average with the confirmation function, we are ready to start this big analysis. As you can see, the trading bot not only displays every valid trade on the charts, but also gives me the statistics about each asset I want to backtest down below on the strategy tester tab. And because I have the premium TradingView plan, I can download all the trades the bot takes, and that's what I'm going to do to create the trading journals. I will speed up the backtest, but you can slow it down in the YouTube settings. I'll see you in a minute. After inserting all the trades on my trading journal, here I got the results of the derivative oscillator on the 30-minute time frame, here on the 1-hour one, and next to it on the daily time frame. In the 30-minute one, after more than 3,800 trades, it achieved a win rate of 49.49% and a small net profit of 9%. Here you can see the results of every asset, and by looking at the equity chart, we can verify that in this time frame the derivative oscillator in these conditions is not consistent. Then in the 1-hour time frame things look a little bit different. After more than 2,300 trades, this tool achieved a win rate of about 52.35% and a total net profit close to 270%. Here you can find the average results and trades per year, and with a profit factor of 1.12 and an average drawdown of about 30%, the strategy in this time frame got a more consistent equity curve with a max drawdown value of about 40%. Again, here you can see the results of each asset in this time frame that allow us to say that on the 1-hour time frame this indicator was the one that achieved better results so far. And finally, on the daily time frame, after 109 trades, it achieved a win rate of 56.88% and a profit of 26%, which can also be noticed when looking at the equity chart, being this result also the best one we had so far in this higher time frame. So overall, the derivative oscillator in these conditions proved that probably it is an indicator that is more suitable for day or swing strategies than for scalping ones, as its results on the 1-hour and daily time frames were the best ones we have so far in this series. Of course, things can change if we add a volume or a filter indicator to this system, but I remind you that in this series I am just testing different indicators on the same sample and conditions to discover which ones are the best. In our ranking sheet, it is not easy to conclude the best place for this oscillator, but by making an average calculation of all the results, I would say that it is in a position to obtain the 3rd place in our ranking. Tell me in the comments if you agree with this placement or not. And so, the dollar stochastic will continue to be our top 1 indicator, as it is the most consistent one we have analyzed so far. If you'd like to know more about it, check out this video on my channel. Also, if you'd like to access this ranking sheet Excel, you can do it for free. The link is in the description. On this tab, you can check all my tested trading strategies, and on this one, the ranking from the indicators tested on this series, where you can also find out how you can access this indicator testing bot I showed you during the video. Just click here. If you think you have an indicator that can beat the dollar stochastic, you can share it with me in the comments or on my free Discord community, and probably you will see it in a future episode of this series. So do not forget to subscribe to don't miss anything. If you enjoyed seeing my working methods and would like to work one-on-one with me to enhance your trading system and become a better trader, you can also see my available services on my website, algotradepro.org. And that's it. Be well, thank you, and I see you in the next episode.